The biggest financial mistake most people make isn't picking the wrong stock. It's not having cash. And that one simple oversight will absolutely destroy you in the next crash. Think about it. Our entire financial world obsesses over portfolios. We talk about index funds, real estate, crypto, credit scores. We optimize, we rebalance, we chase returns. But almost nobody talks about the raw, untamed power of having actual cash. Real money, sitting there, accessible in an instant. No phone calls, no approvals, no selling your assets at a loss, no waiting 3 business days for a transfer to clear. And the mistake of not having it? It's an invisible error. It doesn't show up on your monthly statement. It only reveals itself when the world gets chaotic. And as we all know, the world always, eventually gets chaotic. Today, I'm going to break down 3 reasons why cash is the most underrated financial weapon you can possibly own. We'll explore why the people who quietly build serious, lasting wealth almost always hold more cold, hard cash than you think. And the third reason I'm going to share, it completely changes how you experience money, risk, and freedom itself. Let's start with the first one. Reason number 1, cash turns crashes into hunting season. We've all heard that famous Warren Buffett quote, "Be greedy when others are fearful." It sounds profound. It looks great on an inspirational poster, but in real life, it's almost impossible to follow. Here's what actually happens during a major downturn. The markets start to slide. Then they fall off a cliff, 30, 40%. Panic floods the headlines. Portfolios bleed red day after day. The term layoffs starts trending on social media. Your neighbor who works in tech suddenly looks a lot more stressed. In that environment, nobody feels greedy. They feel terrified. Why? Because all their money is already in the game. They're fully invested. They're watching their net worth, their retirement, their kids' college fund shrink in real time. They're not thinking about buying, they're thinking about how to stop the bleeding. And here is the part that nobody ever wants to admit. You cannot take advantage of a crash if all of your money is crashing too. That's not a strategy, that's just being a passenger on a falling elevator. You are stuck. But the person with significant cash reserves, they experience a crash in a completely different way. For them, the world isn't ending, it's opening up. They become a hunter in a target-rich environment. While everyone else is panic selling, they're shopping. They're buying shares of incredible, solid companies at a 50% discount. They're funding promising businesses that the banks in their own panic suddenly won't touch. They're looking at real estate, maybe that beautiful downtown condo that was out of reach 6 months ago, and now the seller needs liquidity, fast. This isn't some fantasy. It happened in 2008. It happened again in the flash crash of 2020, and it will absolutely happen again. When it does, one group of people will be glued to their screens in a state of panic. The other group will be calmly making a shopping list. But the real advantage of cash here isn't just financial, it's psychological, which brings me to reason number 2. Reason number 2, cash gives you walk-away power. Let me ask you a direct question. Just imagine this for a second. If you had 2 full years of your living expenses, every bill, every meal, everything, sitting in a simple, accessible bank account right now, how would you behave differently at work tomorrow? Think about that toxic boss, the one who sends emails at 10 p.m. A little less scary, right? That company that just went through another round of restructuring, a little less threatening. That difficult client who keeps pushing boundaries and demanding the impossible. Suddenly, their demands are a lot more negotiable. This is what I call walk-away power, and it changes everything. Most people aren't stuck in jobs they dislike or situations they can't stand because they lack intelligence or skill. They're stuck because they lack liquidity. They are completely dependent on that next paycheck. They cannot afford a month of uncertainty, let alone a year. So they tolerate things they shouldn't. They bite their tongue. They say yes when they mean no. But here's the strange twist. When you don't need something, you instantly become more attractive. It's true in negotiations, it's true in relationships, and it's especially true in your career. Employers can sense that you are choosing to be there, not that you are trapped there. Business partners can sense you aren't desperate. That quiet confidence shifts the entire power dynamic in your favor. Ironically, having cash makes you more powerful in situations where money isn't even the topic of conversation. And here's a critical insight that most people miss. The highest earners are often the most financially fragile. You see someone making $300,000 a year, and you assume they're set. But often they're spending $295,000 a year just to maintain the lifestyle. The mortgage, the car payments, the private schools, the vacations. They look rich, but they cannot stop. The gilded treadmill they are on runs very, very fast. Meanwhile, someone earning half that, but who is sitting on a serious cash reserve, has true freedom. Because freedom isn't about how high your income is. It's about how many options you have. It's about optionality. Now, this is usually the point where the critics jump in. They say, but what about inflation? You can't just let your money sit there. Let's talk about that. Reason number 3, opportunity cost works both ways. You've heard the slogans 1,000 times. Cash is trash. Inflation is a silent tax that eats your money. You have to stay fully invested at all times. It all sounds very smart, very sophisticated, but it's an incomplete picture. Yes, it is absolutely true that if you hold $100,000 in cash during a year with 3% inflation, you lose about $3,000 in purchasing power. That's a real loss. It stings. But now let's flip the equation and look at the other side of the opportunity cost ledger. Consider scenario 1. You're fully invested. You follow the advice to a T. The markets drop 30%. At the same time, your company announces layoffs and you lose your job. You need $30,000 immediately to cover your bills. To get that cash, you have to sell your investments right into the teeth of the downturn. You are forced to lock in your losses at the worst possible moment. That $30,000 you sold might have been worth $120,000 5 years ago if you'd been able to leave it alone. That loss, that massive opportunity cost, doesn't show up on any inflation chart. Now, consider scenario 2. You hold significant cash. The markets crash. While others are panicking, you deploy $50,000 into high-quality assets that are now on sale at a 40% discount. That single, decisive move could generate $20,000, $30,000, maybe $50,000 in upside over the next few years. So you have to ask yourself, which opportunity cost is larger? The slow, predictable, visible loss from inflation, or the invisible, catastrophic cost of not having cash when the world goes on sale? And there's an even deeper layer here. Cash allows for patience. When you have liquidity, you don't panic sell. You don't chase hype because you're afraid of missing out. You don't make emotional decisions because you feel cornered. You can simply wait. You can wait for the right opportunity, the perfect pitch. And in the world of investing, patience is a massively undervalued superpower. Let me tell you a quick story that proves this. I know someone who, for years, kept roughly $200,000 in cash. His friends, all savvy investors, openly mocked him. They'd show him spreadsheets and charts. Do you have any idea what that would have made in an S&P 500 index fund? They'd ask. To them, his cash was lazy, stupid money. Then March 2020 happened. The world shut down. Markets dropped over 30% in just a few weeks. His friends were drowning in stress, watching their retirement accounts crater, worrying about their jobs. He was calm, not because he's a stone-cold investing genius or because he enjoyed the chaos, but simply because he had options. He bought his favorite stocks at a huge discount. He acquired a small commercial property for 40% below its market value from a seller who needed liquidity, fast. He funded a struggling local business that today has become his single most profitable investment. 5 years later, that lazy cash position was the foundation for over $800,000 in assets. But more importantly, he never experienced a moment of panic. That psychological stability, the ability to sleep at night during a global crisis, was priceless. Now, here's the part most financial advice skips. The financial industry benefits when your money is invested. They earn fees when you're fully deployed in the market.
They don't earn fees when your money is sitting in your bank account. I'm not saying don't invest. Of course you should invest. I'm saying the right balance is different than what you've been told. Having 3 to 6 months of expenses saved, that's not a strategy, that's survival money. That's the buffer to fix a broken car. I'm talking about something more, something strategic. 1 to 2 years of expenses, plus a dedicated opportunity fund. Enough cash to allow you to act decisively when everyone else around you is frozen in fear. Because here is the uncomfortable truth. The best deals in life, in business, in investing only exist because most people don't have cash when those deals appear. Liquidity gaps create opportunity, and the next liquidity gap is not a matter of if, it's only a matter of when. So, here's the bottom line. Cash isn't dead money.